Okay, so tonight we will pick it up where we left off yesterday, which is where yesterday we finished talking about forward contracts, or at least for the time being. They will show up again later on because it turns out that many of these derivative securities can be combined with each other. And so it's actually possible to have derivatives that are going to combine features of different types, for example, different forward contracts, futures contracts, and options can be combined in some very interesting ways. So the topic of forward contracts will never completely stop using it. It's just that now we can move our attention to some of the others like futures. But just down the road, just to be aware that options can be combined with both forwards and futures to create interesting new types of securities. But for now, we're going to switch our attention away from forward contracts to futures contracts. What we really want to know is how are they different? How are they the same and how are they different? And when would you use one versus the other? I mean, we have these two competing products which are designed for the same purposes. In other words, we're hoping that this will enable us to eliminate any risk that we are taking in the marketplace. And for some types of hedging, one product might be better than the other. And so you'll see that there's advantages and disadvantages to both of them. But neither one is always the better choice because otherwise that the one that is never the better choice would disappear from the marketplace very quickly. So the fact that we have such a large trading volume of both forwards and futures indicates that they both have very important uses in the marketplace. Now, of course, derivatives can also be used for speculation. Although I would say that it would be easier to speculate with options than with forwards and futures. It's a little bit, let's just say it could be done, but it's going to be more difficult. Whereas the options, it's easy. And, so I would expect that you see a lot more speculation with options, but that doesn't mean that nobody speculates with forwards and futures. So just be aware that speculation is the opposite of hedging. Hedging means we're taking steps to eliminate our risk or reduce it as much as possible, whereas speculation means the opposite. We're taking on risk with an eye towards making money if we're right. So they're two very different activities. Now, a lot of people have written articles and books about how speculators are evil. What are they trying to do here? They're trying to place these enormous bets, and it actually turns out that there have been several financial disasters that have taken place over the last 20, 30, 40 years due to people using derivatives incorrectly. Like, for example, there was a bank called Barings Bank in England, and sadly enough, they trusted one of their traders to start up a trading operation in Singapore, and he was hedging. Well, actually, he was speculating with futures contracts in a very reckless way, and basically, he ended up losing all the bank's capital, about $1 billion, and so the company had to be sold to ING for £1. And so, in other words, he basically bankrupted the entire company in just a matter of months. Because well, a part of the issue here was that he was able to hide his losses for a very long time. And so his losses accumulated way beyond levels that would be considered prudent. And so the company didn't know and they couldn't stop him before he lost all of their money. So there's quite a few of these cases that have taken place, but in general, options and futures and forwards are designed for hedging purposes. So anyway, what we're going to do here is take a deeper look at futures contracts and see how they're similar and how they're different than forward contracts. By the way, I just want to mention this, that discussion we just had a second ago about Barings Bank. You can read about it on the internet if you want, but it turns out a movie was actually made about this case. It was called Rogue Trader, as a matter of fact. It's probably available on YouTube at this point. It's the movie is about 20 years old, I would say. And yeah, here's all the details. 1999, right? Okay, 25 years ago. And what's interesting is that, when you see movies based on actual historical events, especially in the area of finance, um, they tend not to get the details right. Um, that can be a real problem. But somehow they managed to not only get all the details right, but they made it interesting. The kind of movie where you didn't have to be a financial specialist to watch it and enjoy it and understand what was actually happening. Now, I see over here these ignoramuses gave it a 30% on Rotten Tomatoes. That's because they don't know the first thing about finance and they couldn't care less. I'm telling you, it was a good movie. All right. So if you're interested one day in learning about a derivatives catastrophe, um, where they're actually showing you what's happening behind the scenes, is why is this happening? How is it possible for him to get away with this? It's really very well done. Um, you don't see a whole lot of good finance movies. This is one of them. All right. Anyway, so let's get back to this. And so futures contracts, now the names, as you can see, futures and forwards, they're similar to each other. They both suggest that something will happen in the future. So both of them are designed to make it possible to lock in the price at which we'll either be able to buy something in the future or sell something in the future. But they do it in a slightly different way, in somewhat different ways. And by the way, this terminology doesn't change. A long position belongs to the person who the counterparty who's buying, and a short position means that you are selling. Okay, that part never changes. Long means you're buying, short means you're selling. Both of them have to be there. You can't have a contract without two sides. So there's got to be a long position and a short position. Now, here's one of the first major differences between the two. Futures contracts are traded on specialized exchanges that focus only on derivatives. In other words, you're not going to find these on the New York Stock Exchange. The most important of all these exchanges in the United States is the Chicago Mercantile Exchange. And I just happen to have their website open right here. And we'll start here by looking at all the different products that they trade. These are all either futures contracts, options, or as it turns out, I mentioned just before, it's actually possible to combine the two into something that's called a futures option, which we will discuss when we get there. And so what you're seeing here is all the different assets that can be bought and sold through futures options and futures options on the Chicago Mercantile Exchange. And you can see it's a very comprehensive list, even cryptos. Okay. It's gotten to the point where you can actually buy and sell cryptocurrencies with a derivative contract, like a forward or a future or an option. And of course, the reason for that is because the demand is so strong. Um, Here's the one thing to keep in mind. Futures exchanges like this one, they make their money with volume. Okay, they need a lot of volume to make money. So they're only going to offer products that are extremely popular in the financial markets. For example, you're not going to see something in here that's only traded by a small number of market participants. Instead, you only have the really heavily traded securities here. And so you see, we have things like we have agricultural futures, which, by the way, this is how futures got started. Um, the idea of having financial futures is a relatively recent development. In fact, in the United States, at least, futures have been around on agricultural products for quite a few years. In fact, they go back at least to the 19th century. But financial futures and options have only been around since the late 70s. Okay, but once they got started, once they were introduced, they proved to be extremely popular, and so now we have an enormous number of these to choose from. But you can get contracts on oil, for example, natural gas. These are indices. You can buy a futures contract or an option or a futures option on the entire Standard & Poor's 500, for example, or the NASDAQ 100. These are good ways to hedge the risk of a market decline, or also to speculate that the entire market will go up without having to pick individual stocks. Okay, so in other words, if you're convinced that the economy is going to do well next year, and but you don't want to get into business of picking individual stocks, you can just, in effect, place a bet on the entire market by entering into a long position in one of these contracts. Because if you're right and the market goes up, you'll make a lot of money. You can make a lot of money in a hurry, as a matter of fact. We have foreign exchange. We have several of the major currencies, mostly Western European. We have the British pound, we have the euro, we have the Swiss franc, but we also have the Japanese yen, the Canadian dollar, the Australian dollar, and maybe one or two others that are available here. We have treasury notes. SOFR is the secured overnight financing rate. It's basically the rate at which banks can borrow or lend make collateralized loans to each other. Okay, we'll get more into this later on because it'll show up in one of our later chapters. But the SOFR rate is essentially it's not exactly risk-free. It's not, something that is guaranteed by the Treasury Department, but it's as close as you're going to get because it basically refers to the transactions in which one bank needs to borrow money and they use a treasury bond or treasury bill as a collateral for a loan that only lasts 1 or 2 days at the most. So it's a rate that represents extremely safe transactions between banks. Then, of course, we have precious metals like gold, we have copper, and this is not even all of them. Over here, we have energy, equity indices, interest rates, metals, options, spot, cleared. They have everything. But here's one thing I do want to point out. You might find this interesting. Under this education tab, they actually have their own courses that you can take completely for free. And you can even get certifications of some kind if you take these courses. So you go through the list and you say, well, I'd like to take this course about the introduction to futures. Well, it's right there. It's free. And if you pass whatever exams they give you, you'll get some kind of certification that you can put on your resume. Wow, that's not bad. Now, you're probably wondering, why are they willing to do this? You'd think that they would try to squeeze some money out of you. But like I said, remember, their business is to sell a lot of contracts. So the more people who understand how they work, the more volume they will get. Okay, that's the way they're looking at it. If you are a treasurer at some company or other and you're thinking about using futures to hedge your risk, this will help you hopefully decide that, yes, this is the way to go. And now there's more trading volume for the CME. And that, of course, puts more money in their pockets. So they're happy to make this available to you because the more you know, the higher is the likelihood that you'll use their products. If you need it, you can also buy data from them. But I'm guessing that it's probably very expensive. But, if, depending on what business you're in, you may need this data. And, they got all kinds of fun stuff here. But from our perspective, we really want to use this to look at these products and understand their key details. Let's say, for example, I want to look at gold futures. Now, what they'll offer you to do is show you the details, specs, specifications. So let's just go through this really quickly. A gold futures contract gives you the right to lock in the price at which you can buy or sell 100 ounces of gold. They don't have any other smaller contracts for this. And now that means this is a pretty big commitment. And they're giving all the other details. Now, the contracts themselves have specific maturity dates. These are available, according to this, in February, April, August, and October in the current year, and then in later years as well. And they'll tell you other things like what is the minimum price fluctuation, which they will change the futures price, limitations on the position you can hold, things like that. They'll have the prices, like here, for example, the most recent price was 23.3250. which means that I can lock in a contract, which gives me the right to buy gold for $2,332.50 in one of these months. Let's say I choose August. And so that's pretty high. I mean, it wasn't that high just a few months ago. In fact, I'll tell you what, why don't we do this? Somewhere in here, somebody will have, there it is. Okay. COMEX is the commodities exchange where gold trades. See if we can find a recent history. I suspect that gold has spiraled upward. I wasn't paying particular attention to it, but I just seem to remember just a couple of months ago, it was only about 1900 dollars. Wow. Oh, so last summer, yeah, look at that, around 19. And then right about February or so, it just went through the roof. So one of the interesting things about gold is that it tends to benefit from uncertainty and turmoil because when people are nervous, they're more likely to put their money in gold. They see it as an investment of last resort, meaning that if you have gold in your house, no matter what happens to the economy, that gold is always going to have a value. So as soon as people are nervous, one of the first things they do is they buy gold. When things are calm, people don't buy gold because it doesn't give you any actual rate of return. Okay, the only thing you can do is hopefully sell it at a profit. Okay. Silver, now these metals tend to rise and fall at the same time. Silver is at 29.41, platinum 960.31, and palladium is at 891.82. These last three are the so-called weight metals. Um, and so there are contracts available on gold, silver, platinum, and palladium. Wow. Now, some of these have, like, for example, palladium is used in the auto industry. So it's not just an investment metal, it's also got an industrial use. Platinum, too, it has some industrial use, so that helps keep the price up. Silver is the same thing. Silver is often used in electronics, so it's not just for investments. Gold, you don't see it as often, although it is used heavily for jewelry and that type of thing. But people watch gold much more closely than these other three. And so when things are tough in the market, you're likely to see a lot of fluctuation in the gold price. Oh my God. So anyway, so this is if you want to enter into a contract, these are the details. Anyway, let us take a look. Now let's get back to this offset. Now, so the first difference between forwards and futures now is that futures are traded on an exchange. So what about forward contracts? Where does one trade forward contracts? Okay, good question. So futures are traded through organized exchanges. And that means that they're heavily regulated, by the way. And so there's a lot of rules about what can and cannot happen with these contracts. There's a separate organization. The government has an agency. You've probably all heard of the SEC, Securities and Exchange Commission, that was set up during the Depression to regulate the stock market. Because let's just say that one of the reasons why we had the Depression, because there was a lot of funny business going on in the markets, which this was designed to prevent. But we also have the CFTC, which stands for Commodity Futures Trading Commission. That's what it is. Their job is to regulate the derivatives markets. Okay, so it's equivalent to the SEC, but for derivatives instead of stocks. So any transactions through the CME, for example, are going to have to follow the rules set by the CFTC. So forward contracts are agreements directly between counterparties. In other words, if I want to feature a forward contract, I basically get in touch with an investment bank or anyone else who's in this business and say, listen, I need a forward contract on British pounds that expires in August. And if they are willing, they'll enter into a contract with me and they'll specify the price at which we can make the trade, and then we're done. So this type of trading takes place in what we call the over-the-counter market. And the same thing is true in the stock markets, by the way. If your stock, let's say you're a tiny little corporation with not that many shares outstanding, it takes a certain minimum amount of market capitalization to be listed on an exchange like the New York Stock Exchange. If you don't qualify, the only way people can buy your stock is again through this over-the-counter market. They have to call up a broker and say, listen, I want the stock of this small company. And they have to go out and find somebody who has it and is willing to sell it to you. So there's no exchange involved with the over-the-counter market. It's just a direct trade between two counterparties. It's a contract. Okay. So there'll be lots of lawyers involved, but there's no exchange involved. Now, in a way, there are good things about that and bad things. Okay. What's good about trading through an exchange, with exchanges, contracts are guaranteed by the exchange. So if I buy a futures contract on the CME and the counterparty can't do whatever they promised, the Chicago Mercantile Exchange will take care of it for me. They guarantee that my contract will be valid, and whatever I agree to, that's exactly what's going to happen. So this means that there is no credit risk. Oh, with a forward contract, though, nobody's looking over our shoulders. I can get together with anyone and agree to anything. So there is credit risk because one of the counterparties to the contract or both may fail to live up to their agreement. Usually it means they've gone out of business, i.e. the counterparty go bankrupt. And then that means, well, you're left holding the bag. Well, I mean, yes and no. I mean, let's say, remember Lehman Brothers went out of business about 15 years ago, whatever it was. If I had a contract with them, I'd be considered to be one of their creditors. And then when the company was dissolved by the bankruptcy courts and their assets were sold off, I might have gotten a little of my money back, but certainly not as much as I should have if nothing had happened. So a futures contract is guaranteed. There's no credit risk, but a forward contract is not. So you might say, well, then why would anybody ever enter into a forward contract? Well, here's the trade-off. Forward contracts are completely flexible. Are completely standardized. So for example, remember I showed you before this gold contract, it says here 100 ounces. What if I only want to hedge the risk of buying 50 ounces? Well, I've got to make a choice. I can either use this contract anyway or just not bother at all because they don't have anything else. I have to either do 100 ounces or nothing. So, that might not be the most convenient thing in the world for me. But on the other hand, I've got the safety here, but I don't have any real flexibility. And a lot of contracts are simply not available on a futures exchange. If I, for example, do a lot of business in Iceland and I need the Icelandic kroner, I'm not going to find it on the Chicago Mercantile Exchange. I would have to go to the forward market for something like that. So you can see there's always going to be trade-offs between the two, costs and benefits. All right, now here's another way in which they differ. This concept of offset Now, if you enter into a forward contract, that's a legal contract. You are expected to live up to your side of that contract, unless the counterparty agrees to let you out of it. If you agree to buy British pounds in August, well, you'd better pay for them when that time comes. Otherwise, you could find yourself in court. But with futures contracts, there's a clever way in which we can actually get out of a position with this concept called offset. So in other words, how does that work? Let me show you a quick example of this. For example, if an investor takes a long position in an August gold futures contract, meaning that we're agreeing to buy 100 ounces of gold in August, he or she can offset this position by entering into a short position in the same contract. Now you might say, well, now you've got two contracts. What's going on? The point of it is that the cash flows from the two exactly cancel each other out. So this means net position for the investor is zero. And that's what they want. In other words, you're not really unwinding, you're not really getting out of this position. What you're doing instead is taking steps to offset it so that any cash flows from one will be exactly offset by the other. So in effect, your position has been wiped out, even though technically it hasn't. It might as well, because there will be no more future cash flows. But with a forward contract, this isn't really going to happen. It's not realistic. You almost certainly will have to go ahead and do whatever you agreed to do. So this extra flexibility is a huge deal for the futures market. A lot of investors choose futures for this very reason, because they may say, well, I'm setting up this hedge, but conditions may change between now and August. Maybe I don't need this gold after all. And if I enter into a forward contract, I'm kind of stuck with it. But if I have a futures contract, I can get around that. Okay, now cash flows. Now, this is one of the really interesting parts. And this is what, by the way, this is what brought down Nicholas Leeson at Barings, this concept of marking to market. What happens with a futures contract is that because the exchange is guaranteeing the performance of this contract, they don't want you to lose money. Or if you do, they want to make sure you know about it right away and take steps to, let's say, improve your position. So what's going to happen here is when you buy one of these contracts or take any position, there's something called a margin requirement. I don't see it listed here, but I think we can look it up. Gold margins, okay. All right, here we go, $10,000. Now, so think about this. If I enter into one of these contracts for 100 ounces, at the moment, the gold futures price we saw is 22.53 times 100 ounces. That means the contract will, if I go through this contract, I'm going to pay $225,300 for 100 ounces of gold. So this margin requirement, which is meant to be a type of collateral, represents about 4%, 4.5% of the value of the contract. So I'm only asked to put up 4.5% into this account, which is called a margin account. That acts as collateral. Now, why do they choose such a low number? Because they know from experience that during a given trading day, the chances of my losing more than $10,000 are pretty slim. What they're effectively saying to me is, we'll trust you with 1 day worth of losses. If you lose all that money, you're going to have to put more money into your account. Otherwise, we close out your position. So in other words, they're basically saying we're only willing to tolerate a single day's losses. If it goes beyond that point, then you either put up more money or we'll just close you out down. And so that $10,000 is not even a real expense. It is simply collateral. And in fact, you can deposit treasuries in your account, in your margin account, so you'll continue to earn interest even while this sits in that account. You don't have this with forward contracts. They don't require this. So this is just a safety feature, really for the benefit of the exchange, to make sure that you don't run up huge losses and then walk away and say, "Oh, sorry, I can't cover this." Now, with Nicholas Leeson, um, like I said, he what he did was he was trading futures on the Nikkei 225, which is the Japanese stock market index, the main one. And sadly for Nick, he thought the Japanese economy was doing quite well and that would continue into the future. So he bought an enormous quantity of futures contracts on the Nikkei 225. And then what happened was, um, soon after, they had a massive earthquake in Japan and the stock market started falling. So rather than just swallowing his losses, this guy, Nicholas Leeson, he actually doubled down his or increased his original bets. In other words, he bought more futures contracts. His logic was, well, they'll recover from this pretty quickly. So I'm going to use this downturn in the market to buy more contracts at a cheaper price. And when the economy bounces back, I will make a fortune. Sadly, it didn't work out that way because what was happening is that the prices kept plunging and he kept having all these margin losses in his margin account. And when it reached a certain point, he had to cover that. In other words, he had to give more money to the exchange that he was dealing with, the Singapore exchange, that is. And the amounts started to get really large, like huge amounts of money were required to be deposited into his margin account. And he didn't have that kind of money. It was a lot of money. It was hundreds of, God, even millions of dollars. And so what he basically ended up doing was he created fraudulent accounts for non-existent customers. And he sent these phony documents back to London. And he said, listen, I've got these customers and they need to finance these different positions. So could you wire me $10 million or something like that? And what he was really doing with it was covering his margin losses. And eventually his situation was so bad, he couldn't cover them. I mean, the numbers were so large that not only was he wiped out, but the entire bank was wiped out. So his stubbornness brought down Barings Bank. And so now I did read later on that he wasn't lucky either because they said that if he had been able to hold out a few more months, he actually could have earned back all the money he lost and then made a nice profit, but didn't happen. So and in this case, because of the fraud, he actually did do some real jail time. A lot of these traders who lose money just get fired, but no, he actually did some jail time. But anyway, so the maintenance margin, this margin is there to act as a protection to the exchange so that, if something does go wrong, they're not left holding the bag. So every day now that the price of gold fluctuates, if the price goes up and you have the long position, they will deposit more money in your account. Okay, so you can make money from this. If the price of gold goes up, your margin account goes up. If the price goes down, your margin account goes down if you have the long position. If you have the short position, it works in reverse. So you can actually start with $10,000 here. And if the price of gold goes up, you can close out your position. Let's say that next day, your margin balance goes up to 20,000. It doesn't take that much of a move in the gold prices for that to happen. You can just close out your account and you've doubled your money, just like that. But on the other hand, if prices go down and the entire margin balance is wiped out, you just lost 100% of your investment. So it's a very risky position. So that's why realistically you should be using these for hedging purposes, not just speculation. So Nick was speculating and he had no idea what he was doing. And that's how he lost the bank's money. Okay. So by the way, if let's go back for a second here. Remember, we saw that the prices, oh, it changed. It just changed. You know why that happened? Because some markets continue to trade well into the night. The CME is in Chicago, but what time is it out there? It's no. This is probably trading that's happening overseas. Um, but I think they close at 6 o'clock Chicago time. But yeah, it's still too late for that. But it did change since we last looked at it. But anyway, um, the gold price itself, when we looked at it, where was that? I lost it. No, here it is. The gold price was approximately 23.18. The two of these don't have to equal each other. If people see the price heading further up into the future, the futures price can actually be greater than the spot price, or vice versa. But on the last day of trading of this contract, they have to be equal to each other. Otherwise, there'll be an arbitrage opportunity. Okay, so that's the only day in which we're guaranteed the futures price and the spot price will match each other. Okay. Anyway, so yeah, here's the discussion about how that would happen, but hedging with futures contracts. Now, what's interesting about futures contracts is that because it's easy to unwind them and get out of that position, or at least offset your position, most hedgers in this market don't actually take delivery of the asset. They're just speculating. Like if you're buying a futures contract on gold, it may be that you simply want to protect yourself from fluctuations in this market. You don't actually need to buy the gold. Now, if you do need to buy the gold, you might want to go to the forward market because there you're really expected to take the delivery. But here, it's absolutely not necessary. So if you're really just trying to hedge your risks without actually buying the gold or selling it, then futures contracts are probably a better choice. In fact, something like 98% of futures contracts do not result in delivery. Okay, they're really more or less just hedging instruments. Now, there's two different kinds of hedges, a long hedge and a short hedge. The long hedge means you take a long position because you have a short position in the asset. Okay, so long hedge means you are going to buy. Oh no, here we go. No, you don't own it. You're going to buy it in the future. Okay, so the long and the short of it is that if you must buy an asset in the future, you can hedge the risk of a price increase with a long hedge, which means by taking a long position in a futures contract. Now, why is that? Well, because here's what's happening. If you have a long futures position and the price goes up, let's say we are in a business where we need to use gold to manufacture some product or other, and we know that we're going to need to take delivery of gold in August. The worst thing that can happen to us is that the price of gold goes up. So we don't want that. But if we have a long futures contract and the price of gold does go up, at least we'll have profits from our futures contract that can offset the higher cost of buying the gold. So in other words, when you're hedging, the idea here is to have a position that benefits if things go wrong in the spot market. Okay, in other words, in the spot market where we actually buy the gold, the price goes up, that's a problem. So we need a hedge that provides us with a profit if that happens. And that's what we're doing here. It's not really different than insurance because when do you get a payment from the insurance company? When something goes terribly wrong, like when your car gets crashed or lightning hits your house or something. You don't get any payments any other time. Okay, so there's the point of the hedge. Your insurance policy is a hedge, which provides you with a payment only when things go wrong with your asset. And then, of course, this works in reverse with a short hedge. If you must sell an asset, you can hedge the risk of a falling price, which is what you worry about. By taking a short position in a futures contract or take a short hedge. Why is that? Because remember, the way this works, if you have a short position, you benefit from falling prices with a futures contract, that is. In other words, with a short futures contract, you actually benefit from falling market prices. So if you're worried about prices falling, then you need a short hedge, meaning you want to have a contract that actually provides you with a profit if prices do in fact fall. All right, actually, I skipped over this previous example. Let's look at this for a second. A U.S. importer needs to buy 100,000 pounds in 6 months. Now, let's be careful with this one. Let's say the exchange rate is $1.30 per pound. If it goes up, that means the dollar is weaker. And in the technical term for this is that the dollar has depreciated. This is what we worry about because we need to buy these pounds with a weaker dollar, which means it's going to cost us more money. Here, we could pay $130,000. Here, we would pay $140,000. So the price is going up is a problem for us. Well, since we're trying to hedge against an increase in the price, we'll take a long position in a British pound futures contract. That way, if the dollar does get weaker, we'll at least have a profit from our futures contract to offset the cost of paying more for these pounds. Now, here's the unfortunate thing, though. If the price goes down to, let's say, $1.20, we're going to lose money on our futures contract. And that means the total cost, either way, is going to still end up being $1.30. Okay, in other words, if it goes up to $1.40, we have to pay more for the pounds, but we have a profit from our contract. If it goes down to $1.20, we'll save money in the marketplace, but we'll lose money on the futures contract. So by doing this, we're locking in a price of $1.30, regardless of what happens in the marketplace. Now, if we're selling, then we worry about the opposite. Okay. So if let's say the exchange rate is $1.30 right now, what we worry about is it going down to $1.20. Because that means when we sell our pounds, we'll get fewer dollars. And as an American company, that's what we care about. So here we say that the dollar is stronger. It sounds good, but not for the exporter, that's for sure. And we say that the dollar has appreciated in value. Okay. So that means since we're worried about the price going down, we're going to take a short position. So that way, if the price does go down, at least we have a profit from our contract. If it goes up, that's good news because we're earning more from our pounds, but sadly, then we'll lose money from our futures contract, which exactly offsets that. So we're still locking in a price of $1.30, any way you look at it. Okay. So, it's like with insurance. You're paying for something that you may never need. Um, but if you do need you're happy that you have that contract. Okay. All right. So now we can kind of summarize these differences. Forward contracts are negotiated between counterparties. And remember, this is called the over-the-counter market. Whereas futures trade on exchanges only. Okay. They're not allowed to be traded in the over-the-counter market. It's like I said, there's a lot of regulation here that guides or determines what is allowed and what is not allowed. Forward contracts are different. That's more like the wild, wild west. Anything goes. But remember, these are counterparties who care about their reputation. So if you enter into a forward contract, you're not going to find you're going to go to a reputable bank or whoever it is. But even then, you could still lose money. Number two, there's default risk with a forward contract, but not a futures contract, as we've discussed. Okay, so now default doesn't happen very often, but it is always a possibility. Okay. Like I said, if you go and set yourself up into a forward contract with JP Morgan or Goldman Sachs, there's a very little real chance that something will go wrong, but it's not impossible. A futures contract may be offset by taking the opposite position. Okay, so the cash flows exactly offset each other. So because of that, most of the activity in this market is from investors who do not want to actually buy or sell the asset. So delivery is rare. 2% or less of these contracts result in actual delivery. With a forward contract, it's almost always the case that the asset is delivered because usually the investors actually want to buy or sell the asset. And then the last one is the market. Oh, by the way, that process of putting money into a margin account, I forgot to mention this, is called marking to market. Which means investors in futures contracts must maintain funds in a margin account. There you go. All right. And so we call that marking to market. By the way, and like I said, if you don't, they'll just close out your account. And that's exactly what happened to Nicholas Leeson at Barings. He couldn't keep up the payments. They were so massive. I think, if I remember correctly, towards the end, one day, the amount required was something like $50 million. It was preposterously bad for him. But what really got him sent to jail was the fraudulent letters he sent back to London, and he also lied to them about his position. In other words, here's the silly part about all this. When Barings sent him to Singapore to set up a trading operation, they put him in charge of both the front and the back office. The front office is where the trading happens. The back office is where the records are kept. So the same person was doing both. Well, talk about the fox being in charge of the hen house. So he defrauded them. And so that's what really got him sent to jail. All right. Anyway, so we got a few minutes left here. What I'd like to do is just briefly take a look at section 5, which is our introduction to options. This is where it gets really intense. Options, in a lot of ways, options are not very different than forward contracts. What really separates them is that a forward contract is an absolute obligation to buy or sell at some point in the future. An option means that you have the right to buy or sell, but no obligation, which means you can change your mind. Okay, that's what really is the big difference here. With the right to change your minds, but in exchange for that, you're going to pay a price to buy one of these options. A forward contract, there is no actual price. Just enter into an agreement. A futures contract, there's no price because all you're really doing is putting collateral in a margin account. Here, you actually have to buy the option. Now, let me just very quickly show you, and we'll do this again the next time we meet because we need to look at it more carefully, but I can show you options. Oh, look at that. The Fed, ooh, CPI is the inflation rate. This often is what determines Fed policy. So tomorrow's going to be a big day. Either the market's going to go through the roof or it's going to have a rough day because we don't know what the inflation number is really looking like. Although from what I understand, it's probably going to be higher than everyone realizes. And that's going to lead to a lot of trouble, but a lot of profits for people who own gold. But anyway, let's take a look at Apple's options. Yeah, if I were a gold owner right now, I'd be pretty happy. I'm not. See, now they just redesigned this thing. Hold on one second. Oh, you know what's missing? We need the stock ticker before it'll show us anything. Now, here it is, options. So these are all the options that are currently available on Apple stock. That's a lot. Look at them all. And right here, you're seeing the ask price, which is what you're paying for it. And so this option, if you wanted to buy this option, it's going to cost you $107.60. Wow. But if you scroll down the list, you can see there's some down here that are a penny. It's so we're going to understand what these what are the different terms and conditions of an option, and what is it that's causing some of these to be so terribly expensive and some of these to be so terribly cheap. And then we want to ask ourselves the question, why would you buy an option in the first place? What did you hope to accomplish? And how is it more powerful and flexible than futures and forwards? Um, Now, options trading has only been around in the United States. Well, I shouldn't say it really took off in the early 70s. Before that, options were traded very rarely, partially because it wasn't clear how they should be priced. In other words, figuring out this price was a huge problem, and it took a long time to come up with a solution or multiple solutions. And in fact, the developers of the very first option pricing model were, we'll see, are Fisher Black and Myron Scholes, eventually won the Nobel Prize in economics because this turned out to be so important to the financial markets. So without these numbers, traders are not going to want to touch them because they don't know what to make of them. So the technology for pricing them took a long time to develop because of its complexity. But once we got it, trading and volume in options just went through the roof because, like I said, they're so powerful. Once that mystery was solved, there was nothing to stop people from buying and selling them. And then the volume of trading predictably went through the roof because they're just so useful. Okay, so that's the important detail. The right, but not the obligation to buy or sell an asset in the future at a price agreed on today. So it's basically a forward contract, except with the right to change your mind. The asset that you're allowed to buy or sell is called the underlying asset. The price at which you're allowed to buy it is called either the strike price or the exercise price. Now remember, with a forward contract, we call this the delivery price. With a futures contract, it's called a futures price. But here it's called a strike or strike or exercise price. So now we're getting into some really deep waters here. But I think you'll find these to be incredibly interesting. Um, Especially when you start to see some of the trading strategies that we can create with these. Forwards and futures are very straightforward. Really, what are you doing? You're betting or trying to place yourself in a position where you benefit from either rising or falling prices. With options, there's so many more sophisticated strategies that we can create with them. It's absolutely an amazing area of study. But we're going to focus at some point all of our attention on the pricing itself, and then you'll see how this can be done in Excel and VBA. And so anyway, so I guess we better knock it off right here. I think this really needs to be we should start this from the beginning in our next session, and we'll take it from there. So it's like we're ready to start the most exciting part of the course, which will take up most of the rest of the course. So anyway, so I'll see you all next time.